Welcome to the world of RH. Albert Einstein's 3 rules of work: out of clutter, find simplicity; from discord, find harmony; in the middle of difficulty lies opportunity, seem especially relevant at this moment. Where compounding clutter from tariffs, global discord as a result of war, and the most dire housing market in decades can make it difficult to separate the signal from the noise. It's important to remember necessity is the mother of invention, and our most important innovations were birthed during the most uncertain times. Transforming a nearly bankrupt restoration hardware into RH, the leading luxury home brand in North America, was not a feat for the faint of heart. While the external challenges are somewhat familiar, our internal opportunities are massively different. We're not closing stores and fighting to survive. We're building a never-seen-before brand that's positioned to thrive. Before we get into the details of our strategy, let's start with a few facts that should quiet some of the noise. In 2025, RH achieved revenue growth of 8% and 2-year growth of 15%, far outpacing our furniture industry peers by 8 to 30 points. Adjusted EBITDA reached $597 million, or 17.3% of revenues, versus $539 million, or 16.9% of revenues in 2024. Free cash flow of $252 million versus negative free cash flow of $214 million in 2024, an increase of $466 million year over year. Those results were despite 2025 being our peak investment year, with $289 million of adjusted CapEx to support our global expansion, plus an additional $37 million to purchase the Michael Taylor, Formations, and Dennison Lean brands to support the launch of our new concept, RH Estates. A strong performance considering the unusual circumstances. Let me shift your focus to our strategy and how we expect our growth to accelerate over the next several years. We believe there are those with taste and no scale, and those with scale and no taste. And the idea of scaling taste is large and far-reaching. We believe our goal to position RH as the arbiter of taste for the home will prove to be both disruptive and lucrative as we continue our quest of building one of the most admired brands in the world. We like to use a simple question to frame our significant opportunity. Who is the home brand for the luxury customer? The LVMH, Hermes, Cartier, or Cucinelli customer? RH has curated the most compelling collection presented in the most inspiring spaces in the world. Our brand attracts the leading designers, artisans, and manufacturers, scaling and rendering their work more valuable across our growing global platform. Our product is both categorically and stylistically dominant, enabling RH to address the largest market of any brand of its kind. We curate across the 7 major product categories: furniture, upholstery, outdoor, lighting, linens, rugs, and decor. And we integrate across the 3 dominant product styles: traditional, contemporary, and modern, which we refer to as RH Estates, RH Interiors, and RH Modern. RH Estates, our newest brand extension launching this spring, will address the traditional market where the RH brand is currently underpenetrated. 60% of luxury homes feature classic or traditional architecture, which influences the majority of furniture purchasing behavior. RH Estates will feature the introduction of RH Bespoke furniture, customizable collections from our recently acquired Michael Taylor, Joseph Duke, Formations, and Dennison Lean to the trade brands. RH Estates will also include the introduction of RH Couture Upholstery by Dimitri & Co. Tailor-made sofas, sectionals, and chairs of arguably the highest quality upholstery available anywhere in the world. Designers will be able to order custom-made sizes and finishes, plus specify COM fabrics. RH Bespoke Furniture and RH Couture Upholstery will enable interior design firms to now specify RH for their most discerning clients in custom projects. RH Estates will also include collections from many of the most talented designers and artisans in our industry. Let's take a look at some of their work. RH Estates will premiere at the opening of RH Milan, the gallery on the courts of Venezia, a 70,000 square foot former palace during Salone, the largest design show in the world, with an estimated 500,000 visitors descending on the city that week. The launch of RH Estates will include a dedicated source book mailing mid-May, an international advertising campaign, and freestanding estates galleries in Greenwich, Connecticut, and the San Francisco Design District opening early summer, and the West Hollywood Design District opening in 2027. We believe RH Estates will become our largest and highest margin brand extension, driving significant growth over the next several years. Let me shift your attention to our multidimensional, physical-first global ecosystem, the world of RH, that goes far beyond a typical multi-channel approach, inspiring customers to dream, design, dine, travel, and live in a world thoughtfully curated by RH, creating an emotional connection unlike any other brand in our industry. The question we often are asked is why physical first in a digital world? Let me explain. Furniture remains the least digitized large retail category with an 80-20 store-to-online split, with luxury furniture estimated to be as high as 95/5. Why do stores still dominate? Comfort, scale, finish, and quality are hard to judge online. Even when customers purchase on a website, most experience the product in a store. We believe the physical manifestation of a brand will continue to be significantly more valuable than an invisible online one. We also believe most retail stores are archaic windowless boxes that lack any sense of humanity. That's why we don't build retail stores. We create inspiring spaces. Spaces that are a reflection of human design, a study of balance and symmetry that creates harmony. Spaces that blur the lines between residential and retail, indoors and outdoors, home and hospitality. Spaces with garden courtyards, rooftop restaurants, wine and barista bars. Spaces that activate all of the senses, and spaces that cannot be replicated online. While most have been closing or shrinking the size of their stores, we've been building some of the largest and most immersive spaces in the history of our industry. Let's take a look at our most recent work. We believe our investments in building completely unique, immersive experiences in Paris, Milan, and London will set the stage for RH to become a truly global luxury brand. It's important to understand that there are several strategically significant businesses embedded in our galleries, including RH Interior Design, where we become the largest residential interior design firm in the world, with projects from San Francisco to Sydney, Los Angeles to London, Miami to Milan, and Dallas to Dubai. We offer design services including interior architecture, landscape architecture, art and antique curation, and turnkey installations. Another important business embedded in our galleries is RH To The Trade, a specialized team that calls on, services, and supports interior design firms, assisting in the design, curation, delivery, and installation of many of their projects. RH Hospitality operates beautifully integrated restaurants, wine, and barista bars in our galleries that generate significant traffic and brand awareness. While our galleries might see several hundred customers per week, our restaurants feed several thousand. With 26 restaurants in operation today and a schedule to reach 40 by the end of 2027, RH is one of only 7 globally owned and operated luxury restaurant brands with 20 or more locations worldwide. We believe our galleries create a unique competitive advantage that will likely never be duplicated in our lifetime, as the cost of construction at the luxury level has doubled post-COVID. To address that challenge, we've developed several immersive new gallery concepts that will enable us to scale in a faster and more capital-efficient manner. The first, and most revolutionary, is what we call an RH Design Compound, currently in development in Naples, Miami, and Walnut Creek. A compound is 6 to 8 independent buildings connected by beautifully landscaped garden courtyards with a sun-filled atrium restaurant anchoring the project. Due to the absence of multiple stories that require steel structures, grand staircases, elevators, complex mechanical systems, and long development timelines, We believe we can build design compounds significantly faster and more capital efficient than our prior design galleries. Another new approach to deploying the RH brand in a faster and more capital efficient manner is what we call a design ecosystem. Currently under construction in Greenwich and Palm Desert, and in the development process in West Hollywood Design District. An ecosystem is a multi-building brand presence on a street, in a neighborhood, design district, or shopping center. Our first ecosystem will be in Greenwich, Connecticut, and includes our gallery at the historic post office, our new outdoor gallery opened last year, and our new RH Estates gallery with an integrated restaurant opening in the former Ralph Lauren building this summer. We've also developed a new single-story gallery ranging from 15 to 20,000 square feet with a dramatic courtyard restaurant targeting secondary markets. We're currently under construction in Los Gatos, California, and are in design development for galleries in Richmond and Milwaukee. We've been extremely pleased with our performance of our first freestanding RH Interior Design office in Palm Desert, California, and have plans to open a second interior design office in Malibu this fall. In total, we have an opportunity to expand our presence in 27 existing markets and open one of our new design concepts in 48 new markets across North America, representing a $2 billion opportunity. Let me shift your attention to our business model and balance sheet. While we believe it's prudent to plan conservatively this year due to uncertainties around interest rates and inflation, and have planned revenue growth in the 4 to 8% range in 2026, we do expect growth to accelerate to 10 to 12% in 2027 and reach $5.4 to $5.8 billion by 2030. Adjusted EBITDA in the 14 to 16% range for 2026, reaching 25 to 28% by 2030. We expect cash flow of $300 to $400 million in 2026 and $500 to $600 million in 2027. Inclusive of $200 to $250 million of asset sales each year. We expect cumulative cash flow of $3 billion by 2030, inclusive of the asset sales, and expect to be debt-free by 2029. While one might look at the current market discord and argue that RH has been in the wrong place at the wrong time, I would argue we've used this period to position our brand to be in the perfect place at the perfect time. Let me explain why. There are two important factors that will meaningfully expand the size of our market over the next 10 years. One is the exponential spending of high and ultra-high net worth consumers on the home. Ultra-high net worth consumers with a net worth above 20 million own on average 3.7 homes. Billionaires own 10. Ultra-high net worth consumers spend 6.4 times more on home furnishings than a consumer with a single primary residence. Two is the estimated $30 to $38 trillion wealth transfer projected to take place over the next 10 years, which is more than double the past 10 years. Not only does the absolute dollar amount more than double, it's estimated that the dollars transfer from 1 to an average of 7 people. It's possible over the next 10 years, our market will be multiple times larger than the past 10 years. When you combine that with our efforts to elevate and expand our product, globally expand our platform, generate significant revenues and brand awareness with our immersive hospitality venues, I would argue that the RH brand is in the perfect place at the perfect time. And we will emerge from this period of clutter, discord, and difficulty as one of the highest performing and most admired brands in the world.
At this time, if you would like to ask a question, press star, then the number 1 on your telephone keypad. To withdraw your question, simply press star 1 again. We kindly ask that you limit your questions to 1 and 1 follow-up for today's call. You may re-queue for any additional. We will pause for just a moment to compile the Q&A roster. Your first question comes from the line of Simeon Gutman with Morgan Stanley. Please go ahead.
Hey, Gary. Hey, Jack. First question, I'm going to talk about demand signals from the consumer. This has been a transitional period for the company. I realize the demand is outpacing a lot of other home furnishing companies, but it's come at a pretty big cost to margin. So expectations around demand improving while we see the margin of the business begin to turn. That's my first question.
Simeon, the margin pressures somewhat disconnected and unrelated from the demand. The margin pressure is really from kind of the investment cadence we have as far as expanding the business, throughout Europe, and some of the margin pressure, coming from, the tariffs, from a transition in timing and resourcing. But you basically have kind of an inflection point of, we're in a kind of a peak investment period from a capital and a expense and, cost perspective, based on the investments we're making, both from a global expansion and North American expansion point of view, and from a product point of view with the launch of RH Estates. I think you have to think about the launch of RH Estates in Q2. We'll have, significant costs with source book and advertising, and launching costs without having, much revenue until we get into the third and fourth quarter. And Estates is, remember, is basically, running late. Our original plan was to have Estates in the third and fourth quarter last year. So we have some timing issues, I think, when you think about, the significant investments we're making, both from a capital and expense perspective. And we're going through, kind of an unpredictable time. So I think that's why it's important as you're looking at the business, you're looking at the model, you're thinking about, being an investor here, you have to have a longer term view than a shorter term view, in periods like these. And, and in many ways, a lot of people are going left and we're going right, as people are pulling back and, trying to manage the margin side of their business. We're investing, in the most significant way we have in our history. And, that's just going to create some timing dislocations from from an earnings perspective.
And then my follow-up, you've made a couple of executive leadership changes. One, a new president, and two, a second person. And in the release, it talked about potentially helping monetize some of the real estate. So can you talk about both of those hires? What prompted them, and then, what does it speak to about the direction the business is heading in?
Well, I think it's explained in the press releases. I don't know if there's anything different than that. We mentioned, we're extremely happy to have Dave Stanchak rejoin Team RH. He's has made a significant impact while he was here, both from a North American transformation point of view and a global transformation point of view, and was involved in really setting up the structure of the real estate for European expansion. And so it's good to have Dave back. I think Dave is probably the most experienced real estate executive on a retail point of view, because he's, both, not someone who's just been involved with mall leasing and, which is typical when you think about most retailers. Dave's been involved in real estate investments. He is an investor. He's had his own shopping centers and controls real estate himself. So he comes at it from an investor perspective, a much bigger perspective, and it's a kind of transformational leader as you think about a unique business like ours, and the platform we're building, which is unlike anything anybody else is doing or has done, at a level of quality and locations and, so on and so forth. So, there's not not anything that I didn't talk about, I think, in the press release. And then with Veronica's joining RH, we've known Veronica for a long time. We've been able to observe her and her leadership and her ability to build what we think is one of the leading manufacturing businesses in North America from an upholstery point of view. But mostly what we, I think about here is not just the upholstery part of our business, but if you think about the best luxury models in the world, whether you're looking at Vuitton or Hermes or Chanel or others, one of the things that's very unique with their business models is they have a very concentrated core business. 80% of their business is in, the leather goods and accessories part of the business. It's very similar to our business from a penetration point of view. 80% of our business is furniture. That's typical if you look at the home furnishings business. So, if you're in all categories, that's going to directionally be the mix. Depending on how you position those categories. And we think there's an opportunity when you look at our business from a global scale of building a unique platform that's synergistic and appropriate for the unique platform we're building from the selling side. I think we've built have built and are building the most unique physical selling platform in the world. And I think it deserves and will be, positively impacted by building the most unique manufacturing and sourcing platform in the world. Eliminating, when you think about the inefficiencies of manufacturing, when you don't control your distribution, there's quite a bit. So long term, we think, we can build a unique manufacturing platform. And as I said in the press release, a combination of owned, joint ventured, and, outsourced, that can be very unique, and significantly accretive, from we think both a revenue, and a cost perspective and a margin perspective. So, so we're excited. We think Veronica is the best person in the industry we've met. We think she's a unique talent and leader. She's an engineer by education and experience, and has a big and very big and kind of strategic view of manufacturing and sourcing. So it's a new level of talent in the company. We've never had someone of this kind of pedigree and experience and talent, and we think she's going to do some incredible things long term.
Your next question comes from the line of Steven Forbes with Guggenheim Securities. Please go ahead.
Good afternoon, Gary, Jack. Gary, with Milan in London slated to open here in short order, curious if you could give us an update on RH Paris, and/or just comment on the anticipated revenue contribution from the broader RH international strategy behind the 2030 reference year you laid out in your prepared remarks. Obviously, just looking today for any color to help support or build conviction around those longer-term outlooks you laid out today.
I'm not sure I picked that question up correctly.
The impact of international as it relates to the 2030 targets, how we think about that growth of that.
Well, I think what we've articulated, most recently over the last few quarters and, really since I think our start, the opening of Paris, Milan, and London is kind of the brand foundation to build on. When you think about European expansion, they're the three most important cities in Europe. We think they're important from a positioning of the brand and a brand awareness point of view. And all three of those are really besides, again, RH England, which is out in the countryside, which was important from a brand impression and awareness perspective, and how to kind of make an entry into the European market. But these really are where we have significant investments in the presentation of the product, the hospitality experience, which we think is going to be critical long term to building brand awareness, throughout Europe. And then, one of the keys here is really not just these key stores, because as we assess the business in Europe, and we have since day one, believe that the basic distribution and where the sales will come from will be long term more important in suburbs and second home markets than cities. That the cities are really going to be the key to brand awareness and driving the brand and positioning the brand, and will do significantly more revenues, we believe, in Paris and Milan and London than we will in other cities. And if we were ranking them, clearly London, we believe, is going to be the biggest market for us, as it should be. But our distribution of business is significantly suburbs and second home markets in North America. 92% of our business is in suburbs and second home markets. And second home markets are kind of like a suburb, right? And about 8% of our business is in the cities. And we think that distribution is going to be similar throughout Europe. And if you looked at Apple's real estate strategy, and you looked at their distribution throughout Europe, which we believe was a good kind of model for us to look at as far as a higher end consumer, and you looked at like Apple's North American kind of distribution versus our North American distribution, their penetration in suburbs, our penetration in suburbs. There's similarities there. We're more highly probably penetrated in second home markets than they are. Most people, have their phone with them. It's one of the keys for, I think, Dave's joining the company too, is just to, continue that leadership into Europe and, building out into the suburbs and into the second home markets to cover the business. So, strategically, we're setting up the business in the kind of key markets that you would from a brand and awareness perspective. And not that we don't think that the business is going to have revenues there. We just think the biggest revenues are going to come long term when you think about the longer term plan as we expand into the suburbs and markets where people really buy much more furniture, both indoors and outdoors.
Thanks for that. Maybe just a quick follow-up. Obviously, great to hear Dave rejoining the company. You talked about $250 million of asset sales in each of the next 2 years. So sort of a two-part question. One, can you speak to sort of the value of the non-core assets or the assets that you don't plan to operate in the future versus the value of the assets RH is still planning to operate in the future? And then maybe any color on sort of timing for 2026 asset sales as we think through the potential interest expense savings.
As far as that mix, I'd say the majority of the asset sales are assets that we will be operating that are kind of sale leaseback kind of properties. And then there's some investment properties that we had in Aspen, and a few other things that we've decided not to pursue for whatever reason. We own a building in Madrid, and we're not going to pursue the development of that. We're fine with the location we have today, and so it's just looking at taking a look at our balance sheet and just turning those assets into cash, as we said we would be doing. So, we've said we have, about $500 million of real estate assets that we could monetize, and we're going to begin to monetize those. Dave has got tremendous experience on that end of real estate, and he feels very confident in what we're going to be able to do. And some of these are properties that we had purchased and had developed over the last 2 to 3 years, I guess. You got to think about a lot of our investment horizons are pretty long. When you think about some of the galleries that we've built, you've got significant time to design and develop and get through the approval process, and then you've got significant time building them. So you have a relatively long holding time, and I think post COVID, all of the construction costs have went up, particularly at the luxury level, and those prompted us, as we communicated in the video, to develop just other faster, more flexible ways to deploy the brand. And when you think about the design compounds and think about where the first couple are going, in Naples, we're taking what was formerly a Nordstrom's site. In Walnut Creek, we're taking what was formerly a Neiman Marcus site. And then in Miami, we're developing, kind of a parking lot site on a key visible area in Miami that was kind of a Bank of America. But we think about those opportunities to be significantly faster and more capital efficient. We've built most of our big kind of, I'd say, the higher investment, higher capital side of the business. We've been transforming the real estate here now for 15 years. And so, even on a European and global point of view, I would say that, we have Sydney coming, but that's a different model that's really being built by the developer. It's not going to take much capital from RH. But we have significant assets we're going to now monetize, turn into cash. And then we've got some assets, in Aspen and other things like that we'll monetize over time. So, so a lot of that will come off the balance sheet. Jack, do you have anything to add?
No, I think from a timing perspective, Steve, we'll just keep you posted. We're not ready to, commit us to the cadence of 2026, and we'll just update you, as things as appropriate.
Thank you both.
Your next question comes from the line of Max Rakhlenko with TD Cowen. Please go ahead.
Hey, thanks a lot for taking my question. So first on the States, can you provide color on how you're thinking about scaling the collection? We know when the books will hit, but how are you thinking about the cadence of the product rollout into the galleries? How are you looking to buy inventory, et cetera? Just if you could compare and contrast this collection versus the modern and interiors launches that you had a couple years back.
Sure. So the books will hit kind of mid-May, and we will. We've got a handful of stores that will get the initial product that we'll be able to kind of test, and then we and get some reads on. But we feel very confident in this collection, so we've went out with a bigger inventory buy, and a lot of it based on just the data. You've got 60% of luxury homes in America that have classic and traditional architecture. So, and it is really the next big trend. So as you think about how the trends cycle through, this trend is, a lot of the product you're going to see cycle through. It's why we've made some of the acquisitions that we made, whether it's the Michael Taylor brand and the famous diamond table and so on and so forth, to really be able to not only have authority, but be able to have intellectual property rights for a lot of the kind of key products that are going to come. And so we just think it's going to be a big building trend. But in the second half, we'll be in how many galleries do we think?
At least
30,
yeah.
about 30, 40 galleries, our top 30, 40 galleries. In the large design galleries, we'll take over the first floor with RH Estates. So this is a significant launch and a significant bet.
Got it. That's helpful. And then just a two-parter on margins. If you could just isolate how you're thinking about the impact of tariffs for 2026, both the cadence and magnitude, as I don't think you discussed that in the letter this time around. And then separately, if we exclude tariffs and some of the timing, shifts that you discussed earlier on the call, how healthy how healthy are your product margins as we think about the long-term targets you laid out? How much higher can the product margins go as you do continue to add, these new collections that, I think come with much higher margins? So if we just think about the core, where can the business go from a product margin perspective?
Yeah, I think, we're not giving the detailed margin forecast, but, our product margins are relatively healthy, except for some, bumps we're going through from a tariff point of view. I think we've, been able to perform reasonably well. If you exclude kind of the weight that we have from, this investment cycle, and the drag from Europe, and you kind of take a look at the business, and I think one of the things we're doing as we think about this business, a lot of times with brands, as you go through the history of brands, you've got kind of the levels and the transformations you make to kind of get to where you want to go. And this cycle we're in now, it's a key investment cycle. Clearly we've spent a lot of capital. We've made big investments to kind of position the brand, not only in North America, but position it in Europe for the long term. And once you get past those cycles, we're going to have great leverage. Opening galleries like we're opening and restaurants like we're opening are significant costs, especially when you're doing them in a different country. There's just more travel, more expense from, hiring people and building new organizations and so on and so forth. So, I just think it's not just the product margins, it's really just the overall margin structure of the business. Once we go post-peak here on this, investment cycle, both from a capital and from an expense and cost point of view, I think the model of this business is gonna look like one of the best models people have ever seen in our industry. So, if not the best model, I would think it's going to be the best model anyone's seen. So, we feel confident in that. We're also, just, from a global perspective, navigating through very uncertain times. And we do have a product mix that is going to be somewhat more cyclical, and have more of a drag. So, when you're really focused on the furniture business, versus the home furnishings, the broader furnishings business, accessories business, tabletop business, kitchen businesses, so on and so forth, you're going to have, more weight, during times like these. So, that's going to, require you to fight for more business. But, that's throughout our history, we've always fought for the business in times like these. We've always been, more promotional than less promotional in times like these. And we think it's times like these that, that there's a lot of fallout, and there's going to be a lot of competition that's not going to make it through these times. There's been greater fallout in the furniture business, as most people know, over the last few years than, in any time in history. And I think there's going to, as long as the housing market, it remains difficult. There's just going to be a lot less competition, and we're going to be, better positioned than we've ever been for the other side of a cycle. As we build out the assortment, especially in estates, think about the estates expansion over really a 5-year horizon from a product point of view. I'd say, over the next 5 years, the estates assortment is going to grow. It's going to build. It's going to become more dominant. The trend is going to, that wave is going to keep building over the next 5 to 10 years, right? So, I just think about the whole model of the business, and that's why, we're very confident in the long-term model. I think what confuses people is most public companies, go public and they kind of manage the business, right? And they have a simple rollout and they're going to do so many stores a year, and, the stores are all the same, and everything's really predictable. And, most of them, go through their rollout cycle of, 5 to 7 to 10 years, however, what amount of time they stay relevant for. And then it usually, becomes kind of a dated concept over time, and that's why we like to say that most retail malls are graveyards for short-lived ideas. Most retail companies don't even, concepts don't live out, the first term or second term of their leases. So, we're going through one of those investment cycles that, will leapfrog this business forward. And you're looking at kind of peak investment cycle and kind of trough kind of economic cycle, right? So, and even with those two, you still get a business here with a kind of a mid-teens EBITDA margin to high teens EBITDA margin. And once you get past this cycle, there's a lot of leverage in this model. So,
Max, I'll add on tariffs. So in Q4, we talked about last year tariffs having an impact of 90 basis points in terms of a drag, and Q4 we had talked about 170. We ended up at 190 in Q4, and the way we characterized that in the last call is that that's ultimately by Q4 you're fully baked into the sort of prior tariff regime. Obviously, things have changed now with the Supreme Court decision, but tariffs come out in and out on turn, as you know. And so while in the, let's say in the first half, you might have some tailwinds from that relatively lower rate that exists under Section 122 today, who knows what happens in the second half. There's obviously a sprint to replace all those tariffs and potentially more, as Trump first said, under Section 301 in the back half. So we're just, we're playing by ear and being, as you know, we're nimble and we're dynamic. But as far as last year's tariff impact was sort of fully baked in Q4, it's a bit of an indicator as to how it plays out in the first half. But, obviously the math will tell you that there's going to be, some relief there as far as that tariff drag is concerned. And so we'll keep you updated as things play out. Obviously, we're watching it like you guys are watching.
Got it. Thanks a lot, guys, and best regards.
Your next question comes from the line of Steven Zaccone with Citi. Please go ahead.
Great. Good afternoon. Thanks for taking my question. I wanted to ask about the cadence of the year from a revenue growth perspective, because the first quarter obviously calling for revenue to be down, but then the full year it looks like an acceleration in the back half. Can you just talk through the points of the acceleration? I assume estates is a big piece. How much is international? Any details you could share would be helpful.
Well, yeah, clearly it's international and estates, and the cycling of estates across the entire platform, international, from opening cadence and just what we think the growth in the first couple of years. We really, RH England is kind of our best point of history, and we know how that ramped, so we expect, the international stores to, have a ramp to them over the first several years. But when you think about the back half, sure, you've got, openings in North America, you've got openings in Europe, you've got the States, which will, in Q3, Q4, you'll start seeing the revenues flow from demand in Q2. And, you'll see a ramp in the States. You'll have a second mailing of the book. You'll have newness in, both interiors and modern. So, all of those things combined, we believe, is a big step up in the business in the second half. And we would have, expected more in the, in the back half of last year and the first half of this year, because the States would have been part of that cadence.
Okay, understood. And then, second question I have is just on the margin recovery of the business, right? Because we've been in an investment period for the business for some time, and I think you've used the term leapfrog in terms of margins in the past. For the longer duration investor, when you look at the business, what do you think is the biggest factor holding back margins from improving? Is it just the fact that some of the investments have taken a little bit longer and have been a little bit higher than expected? Has it been the top line, the macro environment? How do we think about some of the unlocks to see that margin improvement on the other side come back stronger? Thanks.
I think you've just outlined it. I mean, we're in peak investment cycle and trough economic cycle, especially from a home point of view. Not just trough investment cycle, you've had the whole kind of chaotic tariff cycle that's caused, kind of significant disruption on the business. I mean, we've resourced 40% of our assortment, business of our size, resourcing 40% of your core assortment, which is really, 40% of the assortment is probably bigger. It's a larger part of the business, So, it's all of those things together, Steve. So, this is a good time, to buy our stock. This is when people create generational wealth, right? This is no different than trough times in a real estate market, trough times in any kind of a, transitional time for an industry or business. And it's, all businesses in our industry get hit in these times, and all businesses that survive to the other side get a lift in this time. I think what's different is, we've historically been investors during times like this. It's when we've seen the biggest opportunities. But this time is, I think, different than previous times because we're in a kind of a real peak investment cycle. We're opening Europe, we're launching new businesses, and so the opportunity to have a leapfrog. If we're more right than wrong, and we don't have to be completely right, we just have to be directionally right here. And so, we say, don't let perfect be the enemy of great. And, we've got a lot of experience here in this company. We've been doing this a long time. And I think we've proven that we've been a lot more right than a lot more wrong. I mean, if you think about the transformation from what was Restoration Hardware before to what is RH today, if you think about the transformation of this brand, over, a 20+ year period, and try to say, name other brands that have made transformations like that, name other brands that are positioned like we are. These are the times that businesses like ours separate ourselves even farther from the pack. but you have to make those investments. You have to take that level of risk to be able to do that. So we're not kind of a management culture or leadership culture, and we're constantly innovating and investing. But this is one of those significant cycles. It just happens to be, during a significant down cycle, especially focused on our industry. And so, we're in a better position than we've ever been from a historical point of view to weather the storm. And I think if you just think about what does the next 5 years look like from an investment point of view? I mean, we're going to come off, if you take the 37 million and the 289 million, you've got, kind of a peak kind of investment year historically. And then we come off that peak and we come into the, 250 to 260 million, and then that's going to drop to 150 to 170 million a year. So you think about the company growing, the capital investment period coming down, and it's not just the capital, right? The investment, but it's also all the expense that's connected to that capital. All the expense that's connected to bringing up those stores, training the people, building the infrastructure, building the distribution capability in the business. All the marketing and advertising that supports a launch, all the time and energy to kind of build out the assortments, develop all the products at scale, to create a leapfrog, not to kind of slightly outperform, but it's no different than taking a $300 million business that was losing $40 million a year, that was Restoration Hardware, and creating RH that's $3.5 billion business. I mean, think about what the next cycle looks like. The next cycle is, I think, even more magnified. We've given you our framework for the model, and the biggest pieces of the model are the pieces we're talking about. If I was on the outside looking at this, I'd say, hey, what is the outlook for capital investments as they go forward, and not just thinking about the capital, but what is the expense, the cost investments that are connected to that capital? How does that change over the next 5 years? And how does it change over the next couple of years, right? Just over the next couple of years. The investment cycle is post-peak and is going to turn down and accelerate in a downward way, just as revenues are going to accelerate in a positive way, right? And when you have those two things going in different directions, that's when you have inflection points in return on invested capital, on margins, earnings, et cetera, et cetera. So, the framework for the math is pretty simple. I think the strategy, because it's never been seen before, is, can be, suspect and can be hard to understand. There can be less believers than more believers at certain times. So look, I don't blame anybody, for kind of saying, hey, this is, looks like an uncertain time to invest, whether it's in our stock or any stock in our category. But especially, you've got to kind of believe in the longer term bet here. And, we think this is going to be one of the best bets that people will make. As referenced by my personal investment here. So, that's how we think about it.
Yep. Thanks for all the detail. Best of luck.
Your next question comes from the line of Michael Lasser with UBS. Please go ahead.
Good evening. Thank you so much for taking my question. Gary, you laid out this ambitious and aspirational plan to take advantage of what seems like a very large and growing addressable market, and yet the market's not really willing to give you the benefit of the doubt. And part of that is RH has been averse to and does not really look at its business on a same store basis, which is understandable, and that's long how you've articulated it. But at this point, that has defaulted to the narrative where RH needs to grow concepts, extend its physical footprint in order to drive growth, and that comes with a significant cost. And as a result, it may not be able to realize its aspirations, understanding that it's come a long way from its origins, but the market's relying heavily on the recent experience. So why, based on the recent experience, is the default of the market wrong?
I think it's what I just said. You have to think about peak investment period, and what hopefully is a low point in the trough from a market perspective. I think if you pull out the investments, just pull out the European drag of the investment think about it. We're investing in Europe. The European market is worse than the American market right now. We're investing in a time you likely would like to not invest, but you can't make long-term real estate investments and expect to get them all right? So, the why is the simple model, Michael, of saying I'm cycling peak investments and I'm cycling, hopefully what is trough growth, right? And we've got significant growth opportunities as we've laid out. And, and the costs are going to kind of go away. So, a lot of people thought Amazon wasn't going to make a lot of money until it did, right? I think it's that simple. I think about,
Got you.
I think that the key is, don't bake this cost structure into your model right now. You're looking at a peak cost structure, both from capital and an expense perspective. These galleries that we're opening are the most expensive galleries that we've opened, both from a capital and a cost point of view.
Got you.
Yep.
And put it in, thank you. Very helpful. So it put it in parlance that the investment community would think about it is essentially this is the peak of the disruption. There will be significant same brand growth that will lead to sizable margin expansion, especially as these investments moderate. Now, the counterpoint would be, hey, we're living in a world of high uncertainty between the geopolitical, the technological, and other factors. So what would be the sensitivity to your outlook for free cash flow in the event that sales in the back half just don't materialize like you would expect? And without asking you to show your hand, but it is important to the investment case, what options would you pursue in the event you needed more financial flexibility to execute on your strategy? Thank you very much.
Yeah, I think it's a great question, Michael. Look, we got the ability to pull back investments further, right? When I think about the major strategic investments that we had to decide to go international, invest into Europe. years ago, right? These weren't short-term decisions. These were 5, 6, 7, 8 years ago, right? We're making some of these decisions and investments, and those decisions are easy. Are not easy to pull back on, right? But we're cycling those. We've got a lot of flexibility when you think about the next wave of investments, whether it's expanding in North America, whether it's expanding in Europe. You're looking at much smaller investments. You're looking at much more flexible real estate, many more choices, et cetera, et cetera. And you're just not going to have the same kind of cost. I mean, we're going to, the cost of building some of the new concepts that we've laid out, just the way we're thinking about deploying capital in North America through compounds and ecosystems and secondary market galleries that are in the 15 to 20,000 square foot range. Just the real estate risk, the investment risk of those, the financial participation of developers and landlords is much higher than when you're investing in major cities internationally. It's just a very different investment cadence. And we just have a lot, and you don't have the same time horizon, right? So, there's just a lot more flexibility. So when I look at, I'd say, peak investment, peak risk right now. You're looking at peak investment, peak risk, and who knows from day to day or hour to hour about the geopolitical and economic environment. Of course, this is kind of different times, and there's major news headlines are made by tweets and posts today, right? And they happen all day long. So I just think that if you're just trying to say, okay, how do I think about the go forward? There's just a lot less risk. There's a lot more risk, I'd say, over the last couple of years than over the next couple of years. I mean, is there further risk to the housing market? There always could be further risk. There always could be, other things. I mean, could the war escalate? Could China try to take Taiwan? There's a lot of things that can go the wrong way. We can all kind of imagine what those look like. But, it's no different than calculating what the federal funds rate is going to be, right? Like, everybody's been wrong on that. And unfortunately, that's been bad for our business, right? There's supposed to be 3 cuts to the federal funds rate this year. Now it looks like there's going to be no cuts, and there might be hikes. Does that create some short-term risk? It does. Can we navigate through that? We can. Do we have more upside to downside in the second half from a revenue, demand and revenue point of view? We do. But I kind of say, look, if I was on the outside of this today and I had the information that, the outside world has that we're giving you today, I'd say it's, I bought this stock at what, $216 a share. I bought $10 million of the stock. I was wrong. It wasn't the low point. But I don't see, too much more downside risk in the model. Most of the work is behind us, building the galleries, getting the people trained, bringing up restaurants internationally. The product side, I think, is a lot less risky. We're not going into some unknown aesthetic or trend. We're betting on, what is kind of the biggest market, the traditional classic market. And it just so happens, if you look at the trend that's going to come through, that is going to be the next trend. But your question's right. We have toggles we can pull. We have assets that we can monetize. We're pretty good at navigating through times like this. We've got this is my 26th year here. So, I've seen cycles and this team's seen cycles, and we've navigated through, I would say, somewhat similar times, not completely similar times.
Got you. Very helpful. Thank you so much, and look forward to another 26.
Thank you.
Your next question comes from the line of Brad Thomas with KeyBanc Capital Markets. Please go ahead.
Hi, thank you. Gary, first I wanted to follow up a bit more about the RH Estates line. And you, I believe, alluded to working more with designers and decorators in this. And so I was hoping you could talk a bit more if the selling process or how you go to market needs to be different on this line that seems to have so much potential for you.
Well, we do a big business with interior designers. Today we have, I think, like I outlined in my comments, that we have multiple businesses embedded in our galleries. We have a trade team that services interior designers and decorators. That's a meaningful part of our business. We think it will become a bigger part of our business, especially with the launch of RH Bespoke Furniture and RH Couture Upholstery, because that's going to open up the ability to have kind of more customizable product, from a size, fabric, finish, and so on and so forth. And that will open up, I think it should open up that market pretty significantly. We have some other strategies to address that market that you'll hear more about, that will kind of support what we're doing, from a marketing point of view. Estates, I think, is when you think again, you think about kind of the high end part of the business that we're going to address with estates, and that's just kind of the beginning. We'll also address that throughout the entire brand. But let's say, estates represents the launch of RH Bespoke Furniture and the launch of RH Couture Upholstery, kind of, framing those, think about those across the whole business long term.
That's helpful. If I could ask a follow-up on the 2030 margin targets, just wondering if there's any high-level framework to think about perhaps how international fits into that, and how much mix or leverage of sales factors into that. Thanks.
We have it. Yeah, we have some data now. We kind of know, as we've opened some of these, how they're evolving, how to think about how they might evolve and grow. And, so I think we have very reasonable targets internationally, mixed into this. I don't think there's anything that's a stretch perspective. So when you look at, you just look at the total composition of kind of the top line accelerating in the out years to 12% growth. I think the way I think about that is you've got about, 4 to 5 points from the platform expansion. You've got, 3 to 4 points, maybe 5 points from the product expansion. And you've got, at some point here, we think there's a couple of points from the housing market coming back. I don't think we're going to be in a 9 or 10 year downturn of the housing market. Let's hope not. But, if it doesn't come back, it's not like we've got a big number out there for the housing market. We've got kind of a 2 to 3 point hope in, the out years of that plan that we'll see some lift in the housing market. If we see a lift in the housing market, you could see, based on where it's been, you could argue there's a 10-point lift from the housing market in the out years. And if that happens, you don't have us growing at 10 to 12, you have us growing at 18 to 22.
Thanks, Gary. Looking forward to getting my estates book in a few months.
Thanks, Fred.
Your final question comes from the line of Marius Morar with Zalman. Please go ahead.
Thank you, and good afternoon. Just a quick question on the growth outlook for next year. Gary, I think in the video you mentioned that it's a bit conservative. I was just wondering, at the low end, do you sort of embed any sort of deterioration in the housing market or maybe an increase in interest rates?
Yeah, I think, we're conservative, throughout the second half. Obviously, we have embedded, the growth from our platform and the new galleries and the galleries that are, cycling. And we've got, growth from estates and some of the, newness and expansion of the assortment in interiors and modern. But do we have the housing market getting worse? I'd say we have embedded in this the current environment right now, which I believe is worse, and mostly from a geopolitical point of view and a perception point of view, of more things can go wrong than maybe can go right. And I think that's how the markets generally risk times like these, when you've got uncertainty and you've got global tensions and war and oil issues and, the endless amount of things that oil impacts, right? So, did the housing market get better when interest rates, came down somewhat? Not really. Is the housing market going to get worse if they go back? If we get 25, 50, 75 basis points and get 3 hikes, I don't think it gets much worse. I think you've got to think back at history and say, in 1978, we sold, there's 4.06 million homes sold, and that was a low point. And in 2003, 4, and 5, you had 4.06 million homes sold. On average, 4 to 4.06, so somewhere about 4.03. And that's with 53. I think it's 53% more people, right? So it's hard to believe it gets worse than this. Could it get worse than this for a small period? None of us have seen a world war in our lifetimes, right? Is there risk of world war? I don't think so. I think cooler heads will prevail, but, this is uncertain times. So I think whether the interest rates go up or down, 25 to 75 basis points, I don't think it's going to change much in the housing market. If the interest rates go up 300 or 400 basis points, I think that's different. I think they go down 100 basis points with pricing coming down, pricing is coming down across the market. I think you're going to see a housing market acceleration. So, I'd say short term, handicap it as even. I think we're seeing pressure right now. Longer term, I think, you have to kind of handicap it as a positive. Because we've never seen, we're now in the fourth year of the worst housing market in 40 to 50 years. That hasn't happened in my lifetime. I've never seen 2 down years, seen 1.5 down years in my career. I've never seen 3 down years, and I've surely never seen a 4th down year. I don't think anybody has. So, how long does it stay here? I don't know. Call today the new normal and build out from here. At some point, I think housing market comes back. And I think it's more likely to come back than go down. But if the interest rates are moving 50 to 75 basis points to 100 basis points, I don't know if that moves the needle plus or minus. On the minus side, you're getting closer to affordability, right? On the upside, you could have some moderate slowing. I think that the bigger thing is if we have real inflation and interest rates have to rise 300-400 basis points, that's the problem.
That's helpful. And maybe a quick follow-up. In the first quarter guidance, do you also embed any drag from the back order and special order similar to the drag you had in the fourth quarter?
Yeah, do you want to take
Yeah, that's something that's going to take probably until the second half to fully resolve itself, just because the complexities of resourcing. So there's something that's
we take that drag in. Yeah.
Is that getting worse in the first quarter?
There's some modest impact that's over and above what we felt in Q4, and then we'll see the resolution of that in the second half.
Very helpful. Thank you.
It's basically from the amount of resourcing and just the new factories being brought up in different countries, being able to ramp up fast enough. And so, that's the biggest hit, is coming from tariff-related resourcing of, furniture, outdoor furniture, specifically metal outdoor furniture. Lighting is a big one. Rugs is a big one. And furniture is a big one. If you think about our business and you take the furniture part of the business, which is about 80%, and then you take, lighting and rugs, which are the next biggest pieces, those are all being impacted. So you got to, the by far biggest part of our business has been all impacted in a bigger way. Resourcing things like bedding, pillows, throws, accessories, picture frames, things like that, which are not, from a percentage point of view, not a very big part of our business. Much easier to resource those things. Much easier to move picture frames, pillowcases, throws, tabletop, glassware, accessories, things like that. Much more easier. When you talk about ramping furniture factories, lighting factories, rug factories, moving those categories, just more complex. And so, those have been, just slower to scale and transition. When you think about, just the, being on the manufacturing side, our manufacturing partners, moving from one country to another, building factories, scaling them, and then all of a sudden having tariffs change and going, oh God, what do I do now? By doing the right thing, think about the rug business, we, for a while there, India was a big source of rugs, and you get hit with a 50% tariff and you're, sourcing rugs to other countries. There's not that many places, that have, that kind of capacity to move those businesses. So, same thing with lighting. Lighting's very different than any other kind of an item. Again, the more accessories, more seasonal parts of the business, you want to resource Christmas ornaments, things like that. Very simple. When you're resourcing the core part of our business, much more complex.
That concludes our question and answer session. I will now turn the call back over to Gary Friedman for closing remarks.
Thanks. Thank you. Well, thank you, everyone. We know this is an uncertain time in our business. Hopefully, we've shed some light to give you more certainty and more confidence in our outlook and our strategy. We believe this is the most important period in our history, and we've never been more excited about the outlook and what we believe will be the outcome. So we look forward to talking to you soon. Thank you for all the leadership and partnership from our teams and our partners all around the world. Everybody's working hard to kind of get to the next place. And so thank you.
Ladies and gentlemen, this concludes today's call. Thank you all for joining. You may now disconnect.